Got it. Now, how do you find these companies? How did you go about it? Because I'm sure there's multiple ways of doing it. But
most people who look for businesses to buy make a big mistake. They use really just two sources. The source they use is they go to business brokers, or and you can get a business.
You can find a business broker on the internet.
Yeah. Or you can even go on the internet and just put in businesses for sale. Okay, you're going to get back stuff. Okay, the problem is you won't find the best companies that way historically, and the reason is because the good companies never get listed. They're bought by somebody who had an inside track to that company, who knew it was coming for sale and bought it before it ever got listed. The good ones never get there. Okay, so now the real question you're really asking is, how do you get on the inside track? How do you become one of those handful of people who get the bargain companies and the best companies, not how do you be the massive people picking over the stuff that's left over? Well, here's how you do it. There are people out there who already are tied into these businesses at a level where they know when they're coming for sale and know it well before the general public. And if you just think about it for a second, you already know who they are. They're like the accountant, you know. And in fact, if I'm thinking about selling my company, what do? I call up my accountant. I say, hey, Harry, thinking about selling my business. What do you think it's worth? So he knows. Okay. In fact, he's going to help me plan the sale of it even before I think about listing it. That person's contact base is in a perfect position to buy that company. So who do I make friends with on a daily basis? Accountants. And I want to make sure they know who I am. I want to make sure they know what fields I'm interested in. I want to make sure they know what particular profiles or criteria for companies that I'm looking for. And so they're a great source for me. Another source are attorneys. Another source are bankers. Another source are insurance people. Another source is the key employees of companies that I'm interested in, you know, because they're part of the rumor mill, right? They find out when the company's going to come for sale long before the general public. And probably the most prolific source of companies to buy that I've ever had, the ones that have gotten me my very best companies, were sellers of supplies and materials to the target company, to the industry that I wanted to buy a company in. Because again, every time they're calling on a company, they're getting plugged into the rumor mill. You know, that's part of how you sell. You get tied into some relationships at the company. And it's an interesting thing when an owner is really thinking about selling his company, just thinking about it, without thinking, he'll write a little note to himself, call accountant, ask what I could get for the business. And he'll write that little note on the desk. Okay, he goes to lunch. Secretary comes in, sees the note on the desk. Now, in her mind, the company's already being sold. And she tells Harry in production, and the next thing you know, the place is buzzing with the businesses being sold.
What percentage of your deal flow has come through these types of relationships versus brokers?
I would say less than 1%. I mean, maybe one of my deals ever came through a broker.
Really?
Yeah. And the vast majority of them come through one of these, and the majority of them came from suppliers, the salespeople for suppliers in an industry I was already in. That's where most of the proliferation came from.
Got it.
And again, these people are very good. And these are folks, remember, they're struggling to make a living, right?
Right.
Everybody's salesman's out there, he's trying to make a buck. And, you know, you tell them, say, look, I'm interested in buying a company that's one of my competitors. If you hear of any of them that might be for sale, let me know. If I buy the company, I'll really make it worth your while. And I wrote many a $5,000, $10,000, $20,000 check to guys who sold me supplies because they turned me on to a company that at the right time that they were really ready to sell.
Now, it sounds like you're just looking for, you've been looking for deals that you like. What about somebody who's got a passion, they're going into a new business, and they say, well, you know what, I'd like to have a head start, I'd like to have a leap forward and buy a business that's already operating. How do they find a business that's that specific? How do they target it?
Okay, well, again, you would do it through accountants. You would do it through that way for one. But there's also another way. It's a very proactive way of targeting a company that you might specifically want. Every company in any field, I'll guarantee you that there's a trade association that services that field. Those trade associations sell their membership list. And they'll even sell you the list screened for size of company, geographical location, and so forth and so on. In other words, they have a criteria. So you tell them in your request for the purchase of the list, you screen out the sizes and locations that you don't want, you focus on the areas that you do. You'll now get back a list of the companies that fill your criteria within that industry. Okay, now the next thing you want to do is you send them a direct mail letter. You send them a pre-approach letter. And the pre-approach letter can be as simple as, you know, my name is John Jones. I've heard from industry sources you have an excellent company in your field. I'm interested in buying a company in your field. I'm a cash buyer. If you have any interest in selling, give me a call. I will guarantee you send out those letters. I will guarantee you a 20 to 30% response.
Oh, I'm sure of it.
and it's already a qualified list because of the way in which you put that list together.
Right.
Now, you then obviously you're going to follow up with those folks. Not all of them will pan out for whatever reason, but if it's a judiciously applied effort, you're going to find that there's a good chance that'll produce exactly the one that you want. And one little corollary to that: sometimes you cannot buy a company that's exactly what you want to do, but you can buy something that's similar, compatible with what you want to do. You buy that company, and then you divert some of that company's resources now to doing what it is you want to do. And there have been a lot of people that I've worked with in the past who had a great new idea, a phenomenal new idea, and there was no company that they could buy that was exactly it. So we looked for what's a company that would distribute that, what's a company that could manufacture that, and then you buy that company that it's already got profitability, already a cash flow. So now when you add this new product in,
you've got your distribution.
Right, it's already there for you. All the pieces are already built.
What? Now, let's say you contact this company. And by the way, one more question before I hit that one. Would you ever recommend just going out to all the best competitors in that field, whether not through a trade association, but going and just sending them letters?
Yeah, I would.
Would you?
Yeah, absolutely. If you know who they are, you just do it.
Just do it.
The very first manufacturing facility that I purchased, I made a simple product, a front-end fork tube for a motorcycle. I only had two significant competitors. It was in the aftermarket. The original equipment manufacturer, of course, made them. But if you wanted an extended front-end fork tube, the original equipment company wouldn't manufacture that because they don't want the liability issues. So there was an aftermarket for it. There were a lot of little dry shop operations around the country. And there were only 3 significant producers, 2 on the West Coast and 1 on the East Coast. So as a matter of almost happenstance, because I had a passion for motorcycles, I had bought one of these, the fork tube manufacturers. Well, I knew who my major competitor was, and he had no interest in selling because he had a nice little business going. So I went to him one day because I had heard through my supplier that he had started a year before a new company that was producing spoke wheels, real spoke wheels, not hubcaps, real spoke wheels for American cars. And it turned out to be a really hot item, and he couldn't keep up with production. This is the information I'm getting from my supplier. So that said to me, well, let's see if I can show him where his new business is now making so much money for him that why hold on to the old business when he can sell that and take the cash and put it into his new business and make more money.
Right.
So the information I got from my supplier enabled me to proactively go after my competitor, create a deal for him that gave him more money to deploy into a more profitable business than the one that competed with me, enabled me to buy that one, and now I own only 2 major manufacturers on the West Coast, which enabled me to increase my prices,
right,
and easily pay now for both of those acquisitions.
Got it. Got it. Now let's say you target the business, you find the business that's going to become your future dream, or the shell for that, or the
right, yes.
Yeah. And now, let's say the owner says, I want $1 million.
Right.
And you said, I'm a cash buyer, I'm coming in, but you want to buy it with no cash.
Right.
How do you go about getting them from the position where they're saying, give me $1 million cash?
Funny you should ask.
Yeah.
If you've ever asked anybody to buy their company, especially if you're proactive, if you're chasing them as opposed to they thinking they need to sell and they're chasing you, so their attitude is, why should I sell my company? I'm making all this money. Okay. Every owner I've ever met in business overvalues their business. So when you go out and buy the company, they're going to want more for it than it's worth, guaranteed.
Right.
Guaranteed. So you have to have tools to bring them back to sanity. And those tools are tools that we've developed over the years that enable us to do that and do it easily. And again, I'll share you exactly how it's done. We have a worksheet that we put into Excel, and so it's all automated now. You don't have to do any of this mathematics. It's all a lot of math, but you don't have to do any of it in your head. It's all you just enter the number off their financial statements and your button, and it's done for you. But here's what it does. Do you mind if I take just a second and give you a little background here?
Sure.
Okay. Cool. In the late 1920s, there was this thing called prohibition in the United States. And what happened is that all of a sudden a business that was legal, i.e. an alcohol-related business, the day after prohibition, that's illegal.
Right.
Can't operate. Well, the U.S. Constitution prohibits our government from confiscating private wealth. So if the government passes a law that puts a legal business out of business, they have to compensate them for that business, and they have to give them fair value.
Wow.
So they needed to come up with a way of putting value on companies that couldn't be challenged in court, because if it could be challenged, then everybody would be suing. I mean, yeah, they would have paid them, and they still would have been sued because they didn't pay them enough.
Right.
So they had to come up with a really fair way to do this. And in the U.S., they gave this job to the Internal Revenue Service. The IRS came out with a way to do this, and they embodied it in something called ARM 34. And ARM, A-R-M, stands for Alcohol Revenue Measure 34.
But that applies to all businesses?
Well, it applied to this type of business.
To that type of business.
And what they did is they came up with a method for how do you give fair value to a private company.
Because it's not like a 4-time multiple.
Right,
it couldn't
right,
be because...
Right. Yeah, here's how they do it. Okay, it's very simple, actually. I'm going to give you the essence of the formula. What they did is they said there's two sides to a business. There's the hard assets, and there's something called goodwill. Okay, the hard assets, people know what that is. You know, that's the bricks and mortar, the benches, the equipment, the machinery, the inventory. That's the hard assets. And it's easy to come up with the value that they're appraisable. Right. You know, and so you can get the value, a fair market value for those. So let's say they came up with a fair market value on the hard assets, and it's $1 million. But let's say this company makes $200,000 a year in profit. So they say, okay, what's a reasonable rate of return to earn on this relatively safe asset called hard net worth? And let's say it's 10%. Okay, so they would say, okay, 100,000 of the income, 10% of $1 million, comes from a reasonable rate of return on the hard assets. So this other 100,000 had to come from someplace else. That's produced because this business has goodwill value. So then they say, well, okay, now what's the goodwill value worth? Well, goodwill value is riskier than hard net worth. You know, because it could disappear tomorrow. Maybe it's because the owner is a good salesman and he dies, so now they don't have any goodwill. Right. So it's very risky. So they said, okay, if a 10% rate of return was reasonable on the hard assets, because this is riskier, let's use a 20% rate of return. Now I'm skipping through a few of the steps here because I don't...
20% total or 20% for the goodwill?
No, 20% rate of return.
Oh.
On whatever that goodwill's worth.
Got it.
Okay, so if the goodwill's producing $100,000, if you go through the math, 20% return on $500,000 of value would produce $100,000. So therefore, how much money, capital, would it take at a 20% return to produce that $100,000 of goodwill income? And it's $500,000. So now they know the value of the business. You take the hard net worth, which is producing $100,000 of the profit. You take $500,000 worth of goodwill value, which they just established was producing the goodwill income. You add the two together, and the business is worth $1.5 million. And that's the essence of the formula. It's a little more nuanced than that, but that's the essence of the formula. Now, that formula is still used to this day to determine on any business in the United States, doesn't matter what the business is, that value of that company for estate tax purposes, because when that owner dies, the government wants to know how much it's worth so they can apply estate taxes. So they had to over time establish this methodology as an authoritative and an incredibly equitable way to come up with the value.
Incredibly equitable, if it's the law, it's the law. But for me, what about the intrinsic value in the brand and the spirit that the entrepreneurs poured into that, and where it's going to go over time?
And I'll tell you why in business those don't matter. Okay, they don't matter because